Okay, we are back on. No questions came in, so that means you're gonna have to tell Karen that I was just excellent, that it was perfectly clear to all of you. No, in all seriousness, I know that we kind of breezed through a lot of, I mean, that's dozens and hundreds of pages of regulations that we went through really, really quickly. So if you have a question, let us know. Okay, perfect. Thanks, Roxanne. Yeah, that's somebody said that that she had lost audio. Yeah, I'm going to mute us on our side, so when Karen or Steve comes in here and starts cursing fervently, you don't hear that when we're during the break. So hopefully everybody's back now. If you have any audio issue, let us know. I'm going to bop back just a couple of slides here. I felt like it was a good time to take a break because I was getting tired of talking about Obamacare rules. But here's where we left off, right? What are your reporting requirements? So the stuff that we just talked about in the first hour, put that in a nice, neat little box, set it over here, leave the box open because we're going to have to grab out some of those tools still. But we're going to move now for the next 2 hours and focus exclusively on the reporting that you're going to have to do. Like I said, we're going to apply some of those rules. We're going to talk about them and refresh on them. But now we're going to get into the guts of the reporting obligation you have. So the purpose of these slides, as it has been every year, and the purpose of recording the webinar, or allowing you to come in and get it later if you want to, is so that you can come back in and say, okay, I just want to hear it again to start speaking the language. One of the good things that I'm going to tell you is these forms, the 1095-C forms, aren't due January 31st. They've kicked that deadline out. So we'll get to to March 2nd, but we'll get to that in a little bit. So you have more time than you normally do. But I know that many of you are sort of type A, or at a minimum, I just want this crap off my desk. And so might be working on this when staff are bothering you less during the holiday weeks and then, shortly after that. So we're going to go through it right now in full detail, but you can always come back and access it later. And what we'll do with the recording is we'll actually chunk it up. So that we're going to have links. I think we've done maybe 10 different segments before. I don't know how many we're going to do this time. Karen and I will figure that out. But if you're like, hey, I just wanted to go back and refresh myself on what do I put in line 14 to the 1095-C form, we're going to try to have that chunked out so that you don't have to scroll through the whole webinar. So if you find yourself scribbling notes or thinking, hey, I want to hear that again, it will be available to you. Because I know this stuff can be like an avalanche, right? Given what we've already talked about. Now we're going to go through all the weird coding rules and all that. So we'll go through it as slowly and as methodically as we can and try to get to any questions you have. Okay, so who must file the 1094 and 1095-C forms? This, again, is the reason that we have to look at whether you're an applicable large employer. Now, to repeat myself one more time, probably everybody in here has either decided that they're either really close or that they are an applicable large employer. Those smaller school friends of ours that know that they're not aren't even on this webinar. But again, this is just a refresher. But the reason I put that up here is not to highlight that point. It's to highlight this point. If you go about halfway through that paragraph, after the parenthetical that says not filing multiple forms 1094-C, you must file a form 1095-C for each employee who was a full-time employee of the school or ESU for any month of the calendar year. That's why we have to go through and figure out, did that long-term sub who was on a maternity leave work 130 hours in that month? Because there's two ways to be full-time, right? We average 30 in a week, or we work 130 in any month. So the rules themselves, I wish were a little bit cleaner, but I think that's actually pretty clear, right? If they meet either of those two things in any one month, arguably, we should be reporting for them. So if you have a para that works all year 20 hours a week, and we know that para wouldn't be full-time on the average, right? But that para, because we have another para on maternity leave, takes a full-time position to make up for some of that work and works 140 hours or 130 hours in a couple months of the year, we have to then figure out, did that increase their average, right? But even if that didn't increase their average, we may still have to report and consider them full-time for those 2 months, even if we didn't offer them insurance. So that's where this gets confusing, is when you have somebody who works for you regularly, that on the look back method, right, or the counting the last prior year and averaging whether they hit 30 a week, they may not get insurance from you and they may not meet that average, but in a month, they may have, right? If they filled in and did substitute activity driving, The number of things that you have people do, because we don't have awesome pears growing on trees, right? You have folks fill a lot of different roles as you need them. You probably fill some of those roles. But so that's why you have to be conversant with the fact that if you have an employee who's full-time in any month, that employee is entitled to get the 1095-C form. So that's why I put this part up here, because that's straight from the instructions. So the two documents, the two forms that we're primarily working with, if you're new, or if this is a repeat for you, just kind of remember again, the 1094-C, that's the transmittal letter, right? That's like the thing, it's a version, it's different, but it's similar in concept to the sort of the transmittal form that you have for all of your W-2s or your 1091s. That form, right, is the one that explains to the government, here's the school, here's who we are, here's how many of these 1095-C forms we have because of our full-time employees, and it gives them other information. That's the 1094-C. Even though it's numerically before 1095-C, we're going to actually talk about that last, because some of the 1095-C stuff, which is the individual employee form, is going to impact that, how we fill that out. This form is due to the IRS if you're filing it on paper, which I don't think many folks are anymore, whether you're an APTA-Fund or a Software Unlimited. I think for the most part, they've got an electronic filing that you can work with. So if you're filing that form on paper, it's due February 28th. We're in a leap year, so it's actually not the last day of February. If you're filing it electronically, it's going to be due March 31st, 2020. So that's your deadline to send all this stuff to the IRS. The 1095-C form, the form that goes to the individual employee, right, that is submitted, the stack of those is submitted with the 1094-C. So you're not actually giving the 1095-C to the government until you also give them the 1094-C form. That is due, the 1095-C must be given if the employee is full-time in any month. That's not due January 31st. That's due March 2nd, 2020. So your employees are going to try to get their taxes done. Their tax person is going to say, where's your 1095-C? You're going to tell them, well, maybe you'll have told them, we're not giving these out until March 2nd because that's not when they're due, but they're going to say, well, I can't file my taxes. And you're going to say, I'm really sorry. But so we're going to have to dance that dance like we do every year, but they have extended that. So if you have employees who disbelieve you, if you want to just look at it for yourself, one of the documents in the link that Sherry sent all of you is the IRS notice. I think it's notice 19-84, I can't remember. It's the only one of its kind in there. But if you pull that up, it says, plain as day, the obligations under 6066, or which is basically the regulation code section for these 1095-Cs, extend the deadline from January 31st to the 20th of March. We have a question, I think. Oh, there you go. Yeah, this is a good idea. Please provide a chart for any acronyms used. I will do that. I tried to put them in the slide titles, but I will do that. That's fair. That's a lot of acronyms. But I will send that. I will add that to the list of materials here when we put them out. Okay. So there is a 1095 and 1094-C form, but there's also a set of 1094 and 1095-B forms. Make sure if your software offers both, you, as the school that offers a fully insured plan, in other words, if you don't self-insure as the school, the handful of schools in the state that do, you're a little different. If you have questions about that, call your school lawyer. But if you use EHA, you have what's called a fully insured plan, so you're not going to be filling out the 1094 and 1095-B forms. Those are filled out by, generally speaking, by Blue Cross Blue Shield. That's the stuff where the blues indicate to the IRS, yes, these plans meet the minimum coverage requirements of Obamacare. They provide the minimum value that Obamacare requires. You as the school, unless you're self-insuring, aren't required to fill those out. They are similar enough that you might not be able to tell on the face of them. So make sure that when you're going and inputting your data, especially if you're doing this for the first time, you're not popping open the B forms to populate. You're looking at the 1094 and 1095-C forms. Okay, so on to the 1095. This is the one where you're going to spend a majority of your time as you get ready to code this stuff. It's similar to your W-2 reporting like we talked about. This is essentially where we tell the government, here's the employee, here's the school, here's the offer of insurance we made to them, here's how much we asked them to pay, if anything, and did they enroll, did they not enroll? If they didn't enroll, do we have a safe harbor code? The lines 14, 15, 16 of this form, that's the gut. That's where you're going to spend 90% of your time on all this reporting. Each employee receives a copy if they're full-time in any month of 2019, and especially if they're full-time in the preceding look-back period. We'll talk about that little nuance here in a second. But the concept is, if you send in a 1095-C to the government, they are going to presume that that employee met the definition of full-time in at least 1 month. You see why that's significant? Because if you had that employee that went in and told the government, I'm full-time in every month, but they were really only full-time in 1 month, that could be where you're going to have to use that ESRP response we talked about for the tax penalty letter and say, hold on a second. He or she wouldn't have even gotten this form but for that 1 month where they did that long-term subbing, right? So keeping in mind, when you send this to the government, this tells them, this is where we're making our assertion of whether that employee is full-time or not. That's teachers, that's superintendent, all the way on down to a part-time para, right? Anybody we're sending a 1095-C, we're saying to the government in at least 1 month of 2019 they were full-time. That's why it's so important to make sure that if you don't have an employee who was full-time in at least 1 month, we're not sending the 1095-C, because we could accidentally be corroborating a mistake that they made when they reported to the government. So knowing who gets one is really step zero, if you will. If you file this with a 1094-C electronically, that 1094-C is due February 28th. But if you're filing your 1095-Cs and all that with your 1094-C on paper, those are due to the government not until March 31st. Difference here though, right? They're due to the employee by March 2nd, but they're not due till the government until March 31st. So you have to, if you're an applicable large employer in ALE, that's one of our acronyms, you have to give this to those full-time employees. You must file them regardless of potential tax penalties. I had a call last year, I get one every year. Bobby, if we send this in, they're gonna tax us. Yeah, that's kind of part of the deal that we struck, right? That when your board was deciding, are we gonna offer affordable insurance or not, or at least what we think is affordable, that was one of the things that they were agreeing to, is that we may get a tax penalty. So there is no, if we file, holy crap, if we file this, they're going to penalize us. You got to file with fidelity. It's under penalty of perjury, right? But they still have that. But if you're giving it your, best effort, if you're doing it in good faith, they're not going to come and, give you a criminal penalty for perjury. They will if you intentionally don't file one because you're going to get a penalty, right? That is perjury because you're lying to them. This again assumes that you've calculated full-time status for each of your employees. Easy breezy for all your full-time teachers, administrators, 12-month people. We know in at least 1 month they're probably full-time, right? That's not what we're worried about. But the government says it's also perjury if you failed to send us a form when you should have, right? So we need to, again, just make sure to assess whether the employee is rightfully getting that form in the first place. Your deadline to get it to the employees, March 2nd. Again, notice that's different than the deadline of when you have to submit the 1095s and the 1094 to the government. That's March 31st if it's electronically. And employees will begin asking for it annoyingly on January 2nd, or as soon as your W-2s go out and they don't have the 1095 with it because they just forward all that stuff to the accountant and they're going to say, well, we need your 1095. Sorry about that. That's just part of what they do when they extend our debt. So listen, the fact of the matter is they're due March 2nd, but there's nothing that stops you from getting them done earlier. But I want you to know, right, that you've got that extra time if you want it. Okay, so part one of the 1095-C form, not a lot of fanfare here, not a lot to point out. And so for those of you that are new to this, or if you're just kind of remembering getting back into the flow of how we do this, we break this down, right, into each section of the two different forms and then into the subsections or the individual lines when we have to. So we're gonna start at the top of 1095-C, work all the way through it, go to the 1094-C, start at the top, work all the way through it, and hit the finer points as we go. So the only thing, again, that I'll repeat here is that you've got to give this form to any employee who's full-time in any month. So if you've got Peter Para, who's full-time in 9 months but has the summer off, and you have Connie Cook, who's full-time in January, but she quits February 2nd, both Peter Para and Connie Cook get the form. Same with Danny Driver. He was a custodian last year, but this year he only drives bus. The question is not what is their full-time status the day you hand them the form. The question is, were they full-time in any month of 2019? So when we have that teacher who retires, does their 6-month sit out and then start subbing for us, right? At the time they are subbing now, they're probably not a full-time employee, but we're reporting on the tax year 2019 and we're looking at the months in 2019, not where they are right now. So Peter Para, Connie Cook, and Danny Driver are all gonna get a 1095-C. because Peter Para, Connie Cook, and Danny Driver were full-time in at least 1 month of 2019. And again, the information that you fill out in the employer part, right, the left side of this box and the right side of this box for the part 1, that employer information must match up with the 1094C stuff. And I've had some schools where the government sent it all back to them and said, we don't think you're the same person. It was just a, transpose school district numbers 0010 to 0001 or something like that. So they are supposed to, the government says, match up. Make sure that they do before you hit send. I think the software companies probably take care of that, but that's one of the things they really emphasize in the instructions. The new hire rules are a little bit weird. I'm not going to cover those in detail, but what I am going to say is, generally speaking, here's how they work. You hire somebody who is going to be full-time and you know it. You hire somebody who's replacing somebody who is full-time. They're supposed to get this form even if the first month that they work for you is December of 2019. Right? Because if you know they're going to be full-time, you're supposed to offer them insurance like you do for other full-time employees. Similarly, if you know they are not going to be full-time, let's say this December you had a part-time para that resigned at the end of November. You hire a part-time para to start December of 2019 this month. You know they're only going to be about 20 hours this month. You know they're only going to be about 20 hours every month moving forward. You don't give them a form, right? Because you know they're not going to be full-time. Then there's the weird people in the middle where you're like, I'm not sure. So for lack of a better way of explaining it, the safest route is to offer them insurance if you think they might be full-time, but that's, tough to take that back if it turns out they weren't. But you do have the ability to track somebody's status for the next year, measured from their start date, to decide if they are full-time before you offer them insurance. So most of the time, I think schools probably know, yeah, we're hiring this person, they're going to be full-time. No, they're not. If you're really not sure and you're deciding whether or not to offer them insurance or whether or not to give them a 1095C, call your school attorney, because these are going to be harder to report. But I just want to throw out there that for those mid-year hires, what the IRS asks you to do is decide, do we know for sure, or do we know that they're definitely not going to be full-time at the day we hire them? That dictates how you're supposed to handle it from both the 1095 reporting side and the offering insurance side. Okay, so that's part 1, fairly straightforward stuff. That's just kind of the demographic information, the employee information. Part 2, lines 14, 15, 16 is where we're going to spend a majority of our time, the rest of this webinar, and where you're going to spend a majority of your time sorting through the codes. So for those that don't remember, you've got the 3 lines, 14, 15, 16. This must be filed for all 1095C recipients, even if you don't offer them insurance. The question is not, did we offer them insurance? The question is, are they full-time in at least 1 month? It is not, oh crap, we're going to owe a penalty, right? It's, were they full-time in at least 1 month? And if so, we've got to give them this form, even though we're telling the government we didn't offer them insurance. There is on the far left-hand column, the furthest blank column after the descriptions of the lines, is the all 12-month box. If every month is the same for the calendar year, you mark it in all 12 months. And that could be true of any of the lines, right? We'll talk about, because EHA is not a calendar year plan, we'll talk about how that's not likely, especially if you have to use line 15. And you could have somebody who wasn't on insurance last year, but then for the 19-20 year decided to jump on, right? Because we had open enrollment. In that case, when we're coding 2C in line 16 to say, yes, government, they enrolled starting in September, right? So we're not going to be able to use all 12 months for line 16 because they just decided to enroll this year, even though they didn't last year. So it has to be static across the boxes before you can use the all 12-month coding. If any of offer, cost, enrollment, non-enrollment, safe harbor codes, if that's different so much as in 1 month, you can't use the all 12-month box. I think that's pretty self-explanatory, but I get questions every year on that. And again, this follows the calendar year, so we're covering 2 EHA plan years. This is why I say, if you have employees paying a certain amount tethered to a percentage of the single, that's by definition with premium increases going to change from August to September of every year. So you're probably not going to be using the all 12-month box in line 15 if you have to code that, because the amount that you ask them to pay. So just kind of keep that in mind. Here's the big one, and I'm going to pause on it. If you're like, Bobby, I get it, I'm sorry, but I just want to drive this home, because in 3 months, when you're starting to work on the forms 2 weeks before the March deadline, you're going to ask this question to yourself again. You're not reporting on what actually happened outside of a couple of small nuances in here. If they actually enroll versus not, that is going into this form. But what you're reporting in terms of the offer that you made, the amount they would have to pay, and the safe harbors if you need to use one is not what they actually did. It's what they would have had to pay if they'd taken the cheapest single that you offer. We're not, in other words, we're not using what actually happened outside of whether they enrolled or not. That's the only real exception here. What we're using is the cheapest single. What would it have cost them to enroll in the cheapest single that you offer? Not the full family plan, not could they enroll their kids and spouse and pay for it themselves, not what was the board willing to pay for, right? The cheapest single plan is what we're using. And we'll talk more about that, but I just want to keep emphasizing that part of it, because every year I get the question of, well, Bobby, do I have to report it differently? These ones took the high deductible and these ones took the PPO. And the answer is no, they should all be the same because we're using the cheapest single plan for everybody. Okay, so now we're drilling down even further. This is the most nuance we'll use here, but we're gonna go through in this part 2 of the 1095-C each of these lines, and if this is a repeat for you, in excruciating detail. So the first thing is that we're gonna start with here in the part 2 of the 1095-C is line 14. You'll notice if you actually look at the descriptor, it is the offer of coverage. Enter the required code. So that's the one where we're signaling to the government, this is the type of offer we made. It met the qualifying offer standard. It didn't meet the qualifying offer standard. We didn't offer anything. This is the line where we're making that clear to them for each month, or if it's static, then we can put it in all 12 months. You must, again, have a different code if even one of the months is different, and you can't use the all 12 month box. The question of the offer means who could enroll, not who you will pay for. We'll talk about why that is hugely significant, but we get this question every year. Bobby, we say to the paras, we will pay for full single insurance. That does not tell me the full extent of the offer to that para. My question back to you is going to be, yes, I know what the board will pay for, but if that para won the lottery and said, I also want to enroll my spouse and my kids, would you let them? It's a pain in the butt to do the payroll deduction. For a lot of those paras, the cost of the insurance outpaces what they make for the year. So now they're cutting you a check every month. The government doesn't care, right? The government wants to know not just what you would pay for, but who else could enroll. And we'll talk about why that's significant here when we get in the codes. So what is your offer? Not what the board would pay for, who could they enroll? And we'll get into that. There's a difference between offering to all dependents and the employee can pay for it, or telling an employee, no, even if you want to, we're not going to let you enroll your spouse and dependents because I'm not going to hassle with you writing me a check every month. I get the sentiment. That's not a good approach from the Obamacare perspective, right? So not many of them are going to take you up on that, I'm guessing. But we have to say to the government, sure, we agreed to pay the $7,000 for the single, and if that para wanted to pay the $13,000 difference to enroll his or her family, we would have let them. That's what we have to be able to say to the government to use the better codes, right? So be thinking about now if you can answer that question honestly. Make sure that you haven't told a para in the last year, no, you cannot enroll your family. We're only going to let you enroll in the single. So if the district offers full family to Tomcat Teacher, who's a single guy, never been married, and the district offers only full single to Connie the cook, Tom has no family, so he only takes the single. Connie has a spouse and kids, but doesn't want to pay for them, right? But our offer to Connie was a full single. Our actual offer to Connie was not that that's all you can enroll in. It's just that that's all we'll pay for. Connie could have enrolled her spouse and kids. So could have Tomcat Teacher. He doesn't have any, she does. The difference between what we're willing to pay for is not the same thing as what we're offering to allow them to do if they make up the difference. Keep the offer separate from what the board will pay for. That's the biggest part of this. And I'm telling you, every year there are schools that get this confused. I get why. But when you start reading those codes 2 or 3 months from now, you start to, your eyes kind of cross because it's like, well, it looks like this one applies because we only offered insurance to the employee. We didn't offer it to, no, you offered to pay for the employee, but you offered it to their full family, right? That's the difference. Okay, line 14. What are the codes? We're going to go through these one by one. 1A, the one that you'll remember, this is your friend. This is the best one that you can. If you can use 1A, we should use 1A. This is most of your staff. If we offer full family insurance to our teaching staff and administrators, you're going to use 1A. If you offer full single to your paras, you're going to use 1A. This is the code that if you can use it, you should, because it means you don't have to fill out line 15. And it's the one that signals basically that we made basically the best offer that we could have to these employees. To be able to code line 14 with 1A, it must meet minimum essential coverage and minimum value. And again, if you're using EHA, it does. That's one of the things the Blues help us with. It's a great benefit because some employers are sorting through whether they actually have this as part of their plan. We have the luxury of getting to assume that. You must offer to spouse and dependents. Do you see now why that last slide was so important, right? Because if you cannot say, yes, Connie Cook, you can enroll your spouse and dependents, you just got to come out of pocket to pay for it, then you can't use this code. Even if the amount that Connie would have had to pay toward the single is 0, you can't use 1A if Connie couldn't have voluntarily enrolled and paid for her spouse and dependents. And again, it's based on the cheapest single plan offered, and that plan cannot cost more than 9.86% of the mainland single FPL as federal poverty line for 2019. This is different than the affordability calculation. What this is saying is the government isn't even going to pick this form up again to look at the employee's household income. If we can tell them that the employee didn't have to pay any more than 9.86% of the single federal poverty line. So for 2019, the single federal poverty line is $12,490. 9.86% of that is $1,231.51. That means as long as you don't ask any employee that you're reporting on to pay more than $102.63, you can use the 1A offer code. Example, we offer our paras full single insurance. How much do they have to pay on the 1095C form? 0, right? You get to use the 1A offer code because compared to 9.86% of the single federal poverty line number, they have to pay $0. Bobby, we ask our paras to pay $100 a month toward the cost of insurance. What offer code are you using? 1A, because they still have to pay less than 9.86% of the single federal poverty line. Bobby, we ask our paras to pay 15% of a single. Do we get to use code 1A? It depends. How expensive is the single? What is the monthly amount that para would have to pay? If your para has to pay $102.64, guess what? You don't get to use the 1A offer code. We're going to have to use a different one. If it is $102.63, you get to use the 1A offer code. That's the difference here, right? So if you have a system that requires the employees to pay nothing toward the cost of the single, you're going to get to use the 1A offer code, right? Unless you made some mistake in saying you can't enroll your spouse and dependents. If you tie it to a percentage or to a strict dollar amount, you might not be able to use the 1A offer code if in any month they had to pay more than $102.63. This is where planning for Obamacare compliance and coding in the future is different than the reality. Remember, we're looking backwards. How much did you ask somebody to pay for the 1920 and 2021 coverage year? When we're here next December talking about the 2020 reporting year, those numbers are going to change, right? We already talked about the percentage changing. The single federal poverty line is probably going to change, but we don't know that. So you're taking a bit of a risk, right, at this point in figuring out every year how much are we going to ask you to pay for the new plan year. But for our reporting, and from a planning perspective, that's pretty easy to figure out. From a reporting perspective, we know what the 2019 single federal poverty line is. We know what the percentage is. Therefore, we know what the monthly amount is. That's the cutoff for the 1A offer code. Got a chat question here. Oh yes, great question. Is the monthly amount healthcare only or is it dental? This is healthcare only. I should have put that in the slide because somebody asks it every year. PPACA, Obamacare, is based on the health insurance premiums. I know that that's coupled with dental for EHA purposes for the most part. We're talking only about the healthcare premiums. And again, it's not what they actually paid. Even if they enrolled, it's what they would have had to pay toward the cost of the cheapest one, right? So remember that. If you're thinking, oh crap, those employees would have to pay $110 if they get the PPO, even though it's only $95 if they get the high deductible. We're reporting on the high deductible plan. We're reporting on the cheapest single plan that they could enroll in. Okay, so that's 1A. And again, when we get to the forms at the end, I hope this will all kind of synthesize and tie together. But 1A is the best thing you can do for a lot of reasons, which we'll get to. But that's the one that says the government really isn't even going to pick this up and look at it. That's a qualifying offer. It's better, right, than the affordability and unaffordability line, which is 9.86% of their whole household income. So the government is saying, if you can make sure that they're only paying that percentage of the federal poverty line, you can code with a 1A qualifying offer. 1B, and this is where it gets confusing 2 months from now or 3 months from now, offered minimum essential coverage and minimum value to only the employee. Check for understanding, right? If you say to Jane Doe, the para, or to John Doe, the para, yes, we'll pay for the single insurance, but you can't enroll your spouse and dependents, you can't use 1A, right? Because you didn't offer to spouse and dependents. So the only code you can probably use then is 1B, because we didn't offer to them. But don't confuse what you offered to pay for with who they could have enrolled, because you're not going to use 1B if that employee could pay out of pocket for their spouse and their dependents. Have you ever said no to an employee trying to enroll spouse and dependents? If you have said no to some employee, I recommend that we talk, decide why we shouldn't do that, even though it's a huge pain in your butt to collect that money. I get it. I want to save you work here. But what I'm telling you is this notion of, yes, of course you could enroll and pay out of pocket if you want to, is important for Obamacare compliance purposes. Did you offer to only the employee and dependents and not the spouse? That makes no sense. Did you offer to only the spouse and not the dependents? That also makes no sense, right? Well, yeah, sure, Jane Doe, we'll let you enroll you and your spouse because you make $12,000 and it's going to cost 11, so I don't have to get a check from you every month. Short of saying something like that, you're probably not going to use 1C or 1D, right? Don't say to Jane Doe, you can only enroll in as much insurance as your paycheck or as your W-2 would be worth. If you've done something crazy like that, maybe one of these 1B, C, or D codes will apply, but for the most part, hopefully you're not even thinking about using any of these codes. 1E, this is the one that if you ask people to pay more than $102.63 in any month, you're going to be using 1E. Hopefully this is sort of ringing a bell for all of you who have been through this before. 1A, we use if we can. If they have to pay $102.62 in a month, we're using 1A. But if they have to pay $102.64 in any month, we're probably using 1E. This is the one that says we offered minimum essential coverage and minimum value, right? We're not talking about affordability here anymore. We offered MEC and MV to the employee and a spouse and dependents, which is correct if we're doing it the right way. But we made them pay an amount that was more than $102.63. So therefore, we have to tell the government that we can't use 1A. So this is the code that most schools will use. If you're using anything other than 1A and 1E to somebody that you made an offer of insurance to, let's talk, or call your school attorney, because my bet is if you offered them at least some insurance, it should be either 1A or 1E. So example one, the district pays full single to Peter Para and allows him to enroll his spouse and dependents at his own cost. Which code are we using? 1A, because the cheapest single plan, we paid for all of it, right? So Peter's cost was $0 per month, even though his assumed cost, if he wanted to pay out of pocket for his spouse and dependents, we would have let him do that. Example two, the district requires Peter Para to pay half of the single premium. Let's say that's $3,500 or $291 a month, $67 a month, and would also allow him to enroll his spouse and dependents. Which code are we using? 1E, not 1A, right? We're using 1E because, yeah, Peter and Peter's spouse and Peter's dependents all could enroll, but they had to pay more than $102.63 in the month, or at least in 1 month, but probably in all months for Peter's sake. So now we're going to have to use 1E instead. 1A and 1E are going to be the ones you're using most of the time. Again, if you've offered insurance to that. We'll talk when we get into the later codes about we didn't offer insurance because they didn't work here then. We'll get to that. If we've offered somebody insurance and you're using something different than 1A or 1E, take a step back and think through it again, because there may be something off on that. 1F is something we don't have to worry about because we have EHA. We offer minimum essential coverage, but not minimum value, right? That's not something we have to fret with, which is, again, an awesome thing. 1G is non-full-time employees enrolled in a self-insured plan. The handful of schools that self-insure in this state may have to think through whether 1G would ever apply, but anybody who's on EHA, Blue Cross Blue Shield, isn't gonna have to worry about it because we're not self-insured, we're fully insured. 1H, this is the other code that you will use fairly often, even if you're also using 1A, right? 1H is no offer of coverage for that particular month. It applies if the district did not offer any insurance and that employee was full-time in that month. This code includes months when the recipient was not an employee. So the new teacher that we hired that doesn't start until August, in January, right, through July, if we allow them to enroll day one, or through August if they don't start till September 1st, that teacher is going to be 1H when they weren't even working here, right? They're going to be 1H from January all the way through the month where we offered them insurance. We'll talk about how to code the month of August when they say, yes, I want to enroll, but they don't get to start until September. That's a different box in it for a different time in this presentation. 1H is we didn't offer them insurance that month, and here's why, right? And we explain that in the later boxes. If you have somebody who is on COBRA coverage, you're using 1H because even though they're COBRAing, you're not offering them insurance. This happens fairly often, right? Bobby, our offer to them was this. They went on COBRA. Nope, 1H because that's through COBRA, right? That's not through us as the school. So that's 1H. We'll use some examples of that. 1I, right? The 1I code is reserved. That used to be transition relief. Remember back in the day when we had transition relief? Yeah, all that stuff is gone, has been for several years. They just haven't taken it out of the form yet. 1J is minimum essential coverage and minimum value to the employee. That is a conditional offer, conditional to the dependents and conditional to the spouse. Again, schools aren't probably going to use this. Who does have to use this are employers. You may have some of these employers in town, right, that are saying something like, you can only enroll in our insurance if your spouse doesn't get an offer. So if the local grain elevator says, yeah, man, this stuff is really expensive. If your spouse works for the school, you got to take that stuff. We're not going to let you enroll. That is a conditional offer of insurance. There's something that has to be satisfied before we let you enroll, right? For schools, we don't have that. We have an open enrollment period. If we're offering you insurance, it's because we're saying you're full-time, or even if you're not full-time, we've decided to still offer you. There's no contingent upon their spouse not getting an insurance offer through the grain elevator. Now, some schools did ask about using this a system like that. I think the answer is it's lawful, right? But I don't think any school is probably going to use 1J or 1K on a reporting basis unless you truly have some weird conditional setup like that. But because other employers in town may have that, it could be causing some confusion for your employees who look at their form and say, well, this looks different than my husband's. Yeah, because they worked for this employer that had a conditional offer of insurance. Not your problem, but most of the things that aren't your problem in the school become your problem, right? Well, how much should I put into my 403B? I don't know. Why are you asking me? So anyway, that's just the bookkeeper, business manager. That's part of what you get whether you signed up for it or not. Again, you're probably not going to use this stuff very much. It will create some uncertainty among employees. The questions I get are not whether we should be coding these, but it's that the husband came in with the para, or the wife came in with the husband, that's our employee, and says, hey, we got this. Can you tell us what this means? This is more just so you have some idea of how to foul off that pitch. If it says something like, well, yeah, we got an offer and it's conditional, and we got turned down on healthcare.gov, and that's really where it causes, those are the calls that I get. So if you get a 1J, if you think you're going to use 1J or 1K, call somebody. You probably don't have to, but you could get questions about it. Okay, that's all for line 14. Those are all the codes, right? And we'll talk more about them in the samples. Looking ahead, do you have any idea what the federal poverty line will be for 2020? Great question. When we're doing reporting, we're looking backwards, so we have perfect information. We know what the federal poverty line is, and we know what the percentage of affordability is, right? We know all that stuff. So this person that asked the question of what will the federal poverty line in 2020 be is really saying, how much can we ask people to pay on a move forward basis? The short answer is we're not going to get the 2020 federal poverty line number until sometime in January, February, or March, probably. It's been as late as March before. I hesitate to go into this too much, but here's what I will tell you. Obamacare has an answer for when you know what the percentage is going to be in 2020, but you don't know what the federal poverty line is. And the answer is you can use the federal poverty line number in place with it. That is the one that's in place within 6 months of the start of your plan year. So if you're planning for how much can we ask people to pay in the future, you can use the 2019 number. Some of you are saying, I want to wait for the 2020 number because if it's higher, we can ask them to pay more. That's fine, right? But that's a risk that you're taking because we're not going to have perfect information on 2020 until we know what the single federal poverty line is, and we already know it's 9.78% for affordability. So if you want to talk planning, right, call your school lawyer because there are rules that help address that. But for our reporting purposes, we're looking backwards. All right, line 15, right? So we did line 14, that's the offer. Line 15 is how much money did we ask them to pay? Bookmark this, footnote it, highlight it. If you are checking 1A, if you're using 1A in line 14, you don't put anything in line 15. I'll say that again. If you're using 1A, you don't put anything in line 15. Similarly for 1H, right? If we didn't offer them insurance and there's no amount in line 15, they would have had to pay for the cheapest single. The benefit of putting 1A is even if we ask the employee to pay $102.62, we still don't have to put that in line 15 because the 1A offer code allows us to skip line 15. However, if we ask paras to pay $150 a month, then we're going to have to use code 1E, which is going to require us to use line 15. So if you are coding 1E because you can't use 1A, you have to fill out line 15. There are rare cases, like the case where you tell the para, no, you can't enroll your spouse in dependents, where you might have to use 1E, but their dollar amount is still zero, right? So that's not to say that you can't have a lower dollar amount in line 15 than $102.63, but that will be super rare. If you think you're putting less than $102.63 in line 15, step back and think about that again, because chances are you should be using the 1A offer code, right? But there are certain weird circumstances where it could happen. I just footnote that if you find yourself using code 1E and putting less than that single federal poverty line number, step back and ask whether you should be. This is what the IRS uses. This is what that ELF that the IRS uses to compare what the employee said on healthcare.gov and what you have said you offered them and what it cost them, right? So it's really important to get line 15 correct, especially if how you got to the amount that they can pay is purposeful, right? If it's because we don't want to owe a tax penalty, getting that number right, that number is what the government's going to use to decide affordability. You're reporting what it would have cost them to enroll in the cheapest single plan that you offer, not the plan that they enrolled in necessarily, right? Again, just to highlight that part of it. If you offer the dual choice, the $1,050 deductible or the $4,000 deductible, you're putting in the amount in line 15 that they would have had to pay if they took the cheaper of the two plans. The single insurance, cheaper of the two plans. Again, regardless of how many they have in their family, we need to offer to let them enroll their family. But regardless of how many they have and regardless of whether they actually enroll, that's what the government wants to know. Because, and it makes sense if you step back and think about it, you're only going to owe a penalty if they don't take your insurance, right? So that's why the government has to know what it would have cost them for purposes of figuring out the penalty stuff. And again, line 15 covers 2 plan years. So unless you keep the amount they owe static, you're probably not going to use the all 12-month box. Because once the premiums increase from August to September of 2019, right, which they did and which they will in August to September of 2020, the amount they're going to have to pay is probably going to change, especially if it's tied to a percentage basis. And it might change because the federal poverty line number is going to change too, right? There are a number of reasons, but unless it's the exact same amount throughout the entire calendar year, not plan year, you have to put the amount in each month. And we'll look at an example of that too. There is some good news, which is this. The instructions allow you to annualize the employee's required contribution each plan year by taking the total employee cost over the plan year divided by 12. This is done on a per plan year basis, and this is actually a change, the one big change from the last couple of years. So in your handouts, this is wrong. Circle this, star it, highlight it. We'll put these new slides up there, but I was reading through this just yesterday again and caught this. You can only annualize on the plan year basis. You cannot annualize on the calendar year basis. You see why that's significant? We ask paras to pay during the 9 months they work so that we don't have to collect checks from them in the summer to pay their share of the premium. We can take the September through August amount that we collect, that we expected them to pay, and even if it was different in each month, we can annualize it, which is nice, right? Because then that means you don't have to put 0 in July and June and August, whereas you're putting 212 in the other months. It could be that you actually get to use the 1A offer code now that you can annualize it, but you wouldn't have before if we had to report it accurately for the 9 months we collect. Each plan year, you can take the total amount we expect them to pay and divide it by 12 and put it in here, right? That's super helpful in my opinion because it makes it so that you don't have to go through and actually look at the exact amount for each of those different pay periods or each of those different months. You can go in and put the total amount divided by 12 through the plan year. Our problem, of course, is our plan year is not on a calendar year. So even though it's great that we can do that for both the 18-19 and 19-20 plan years, those numbers are still going to be different, so we still can't use the all 12-month box, right? Depending on how you charge them. So double check. Always double check. Anytime you're filling out line 15. For 2019, if you're putting less than $102.63 in any box, you've done it wrong, right? That should be a 1A qualifying offer outside of a few very, very rare exceptions that I've only had a couple of times over the last 5 years. If you're ever putting $100 into line 15, ask yourself, should I really be coding line 14 with 1A and not have to fill out line 15? Always double check your line 15 number. Cash in lieu, we're going to hit on fairly quickly. We do this every year. Here's the short answer. If you have a cash in lieu system, you have to have the employees sign what is called an eligible opt-out attestation form, or we have to get reasonable proof that they have qualifying insurance outside of the school. Here's again, we're going to cover this quickly because I'm already running out of time here. But the IRS takes the position that if you charge somebody cash in lieu and they have to make the decision between taking your insurance or taking the cash, they're giving up the cash amount to take your insurance, which means their actual cost is both, right? If I have to pay $100, $90 for the insurance, but I could get a cash in lieu amount of $50, but man, I need the insurance. The government thinks then that's actually a $140 a month cost. Because not only do they have to pay the 90, they're giving up the 50. So you have to code it that way unless you have what's called an eligible opt-out arrangement. So there is a way to do cash in lieu where it doesn't impact your reporting, but you have to make sure you do it the right way. If we offer straight cash as wages in a cash in lieu, we have to make sure that we get the eligible opt-out arrangement, which I will define here in a second. If we put a certain amount of money into a 125 plan for an opt-out, that could be yet a different answer depending upon what that employee can do with the money in the 125 plan. Generally, if they can pay the cost of their insurance premiums with an amount you put into a 125 plan, that doesn't necessarily count as cash in lieu. There are still a handful of you out there that are called flat salary schools. I've worked with several of you every year on this issue. It hasn't gone away. How you treat your cash in lieu system or how you treat we're putting a flat amount into a 125 plan and you can pay premiums with it if you want to, is again dependent on the conditions and authority and what they can do with that amount when you put it into the 125 plan. So if this is not you, if you don't have a Flex or 125 plan, feel free to ignore this part. If you do, and we're using that as a vehicle to funnel cash in lieu or to funnel a flat salary into, make sure you got your arms around this or call your school lawyer to figure out how that's going to impact your reporting. If you use cash in lieu in any form, and it could otherwise qualify as an eligible opt-out arrangement, the employee must provide you reasonable evidence that their entire tax family is enrolled somewhere else that has insurance that meets the minimum essential coverage and minimum value requirements. We get the benefit of assuming that under EHA, but that doesn't mean the co-op's insurance or the Dollar General's insurance or whoever else they might work for in town have insurance that we know meets these requirements. You can't give somebody the cash in lieu though, unless you know that that's true. That's where it becomes difficult, right? How do you know if somebody brings in their insurance plan, whether it has minimum essential coverage, minimum value? You're probably not going to, right? That's why we are allowed to accept from the employee what's called an attestation form. So we have to, number one, provide reasonable evidence the employee's entire tax family is enrolled in qualifying coverage. Number two, we have to make sure that that coverage is not from healthcare.gov or from an individual marketplace. Reasonable evidence can include an employee attestation form. So if this is super confusing to you right now, take a step, sit back in your seat, take a deep breath, and hear me on this part. If you have cash in lieu, you don't have to collect copy of their insurance card, copy of their plan. You can have them sign an employee attestation form or provide proof of enrollment. You can do both, but you don't have to. So our recommendation for schools that use cash in lieu is to have this employee attestation form that you use, which has them assert all of these things are true. That puts the risk on the employee. That says if we find out you're lying and you don't have your tax family enrolled in your spouse's coverage at the co-op, we don't pay you the cash in lieu anymore, right? Because we can't pay you the cash in lieu without it hurting our reporting unless we know that we have an eligible opt-out arrangement. You have to receive that form every year within a reasonable time period close to the proximity of the start of your plan year, which the government says, and I quote, should be within a few months of the start of your plan year. We have, Bobby, we have cash in lieu. Recap what you just talked about for the last 5 minutes because I'm confused as hell. Totally understand. We have cash in lieu. If you do, you should have an attestation form the employees fill out. That attestation form should include that I don't have my insurance through healthcare.gov, that my entire tax family is covered, and that it's qualifying insurance, right? And we have to get that form from them every year. We can't have a ditto mark, right? Every year we're going to pay the cash in lieu because every new year is a new Obamacare reporting year. Every year we have to get this attestation form within a few months of September 1st, the start date. So in August, you can say to all your cash in lieuers, I need this form back or you're not getting the cash. That's how it has to work. So that will have collective bargaining implications and all that. I get that. If this is confusing to you and you want to talk through it, let me know. But if you have cash, you're not using the form, that could impact your reporting. If you don't have cash, feel free to ignore the last 5 minutes. Okay. Yeah, if you're required to report cash in lieu, right? If we don't use this form, if we have to account for that cash in lieu and it's more than $102.63, again, you know that you have to use 1E and you can't use that 1A offer code. That's where this cash in lieu can hurt you, right? Is it can make it so that you may be subject to penalty, even though your insurance is otherwise affordable, but for having to count the cash in. So that's why it's important to get that right. Okay, line 16, and then I promise we'll take a break. This is where the only part of reality sets in. This is where we tell the government, did the employee enroll or not? And it's where we tell the government we have met a safe harbor, even if we have to use the 1E code in line 14 and put a dollar amount in line 15. Line 16 is where we ask for our transition relief, the W-2, the federal poverty line, which doesn't make sense because of the 1A offer code, and then the rate of pay safe harbors we talked about earlier. That stuff goes in line 16. Generally, this is the line where you justify not having to pay a tax penalty. However, and this is a question I still get every year, in many cases, line 16 will be blank. If we offer full family insurance to a teacher that does not enroll in our insurance, we're probably not going to have anything in line 16, and that is totally acceptable. All of you good rule followers out there hate that the boxes aren't perfect and that some of them are blank. And I get that. But it is entirely possible that for a significant number of your staff, line 16 will be blank. Blank in line 16 is just as good as any of the coding in a lot of the cases that you're going to deal with regularly. Good example, we have a 1A offer code in line 14, which means we don't have anything in line 15. And if they don't take the insurance, line 16 is blank. We're not going to pay a penalty because we have a 1A offer, right? But the government knows they didn't enroll because we have a code for if they enroll. So what you're telling the government is, these folks, when you look at our schools or our ESU's report for them, they must have enrolled someplace else. So we should be looking for a different 1095-C that applies to this family. We should be looking for their insurance company filling out the B forms because they didn't get it from this employer. If there are two employers involved, right, one of them, if they're covered by Obamacare and the family enrolled in one of them will have that they enrolled and one of them will have that they haven't. So it's very natural that this line is blank, even if we made a great qualifying offer to them that they didn't take. You must use only one code per month. And again, unless all 12 months applies, which is possible in these cases that all 12 months applies, we'll look at that. And there is a hierarchy when more than one code could apply. So if you have somebody on COBRA, right? Or if you have somebody who's in a wait period, like a new teacher who enrolls, but it's August, right? And they don't start their insurance until September. Now they've enrolled, we made them the offer, but they're not yet getting coverage. There are different codes that could apply there, and we'll go through the hierarchy for when they may overlap. And again, there's no more transition relief to worry about. So I think we have a question here. is money into the employee's HSA cash in lieu. If, for example, we have the option of enrolling in the $1,050 deductible and we'll pay the single, or you can enroll in the high deductible HSA plan and we'll put the difference into your HSA, very common arrangement. I think EHA and Blue Cross say you have to do that. I disagree with them. Unless that's in their underwriting rules, it's certainly not required by law. I get why they would want you to do that, right? But if you are just saying you can enroll in either of these, but we'll put the difference in an HSA, that is not a cash in lieu. Because what we're asking is how much would they had to pay toward the cost of the single premium, right? That answer is going to be whatever we would charge. And it's probably $0 if all we're doing is putting the difference between the two plans into the HSA. However, if what we're saying is all paras get $10,000 into an HSA or a flex plan or a 125 plan, and then with that, they decide what to do, including they can cash it out, right? That's like a flat salary type of arrangement. That may or may not constitute cash in lieu, right? So if you're one of those schools, you have to talk to your school lawyer about it. Unless you've got it figured out from past years, that's entirely possible. But if we're just putting in the difference into an HSA, that's not a cash in lieu system under the Obamacare rules. I can see how it would look like that, right? Because if you take the more expensive plan, you're not getting any cash into an HSA. That's true. But this is part of Obamacare. We're not talking about reality. We're talking about what it would have cost to enroll in the cheapest single plan. Good question. Okay. Keep them coming. We're going to breeze through line 16, then I promise we'll take a break. Okay, so what are the codes for line 16? 2A is a code that you'll use fairly often. That teacher that doesn't start working for the school until August is 2A in line 16 and 1H in line 14, January through July, right? Because they didn't get an offer of insurance because they didn't friggin' work here. So 2A is they didn't friggin' work here. They didn't register 1 hour of service in that month for us. 2B, as the employee did work for us, but they were not full-time during that month. So it is entirely possible, right, that you're going to have somebody like a substitute that works for you regularly, who subs a couple of days a week, but then starting in March takes a long-term subbing for a maternity leave. That person is probably going to be 1H in all those months because we're not offering that sub insurance, right? But in a lot of the months, they're going to be 2B because they weren't full-time. And then it's possible that when we get to those months where they were full-time because they were a long-term sub and they worked 140 hours for that teacher, line 16 may be blank. We're probably not going to get penalized for that person, right? Because on the look-back aggregate, we didn't have to offer them because they aren't full-time on average. But they were full-time in a couple of those months, which means we must pay them, we must give them this form. So we'll talk about those examples and I'll answer your questions. But 2B is yeah, they were working for us, but they weren't full-time in that month. This would include, for example, the employee that you fire on February 2nd, right? In January, they may well be 1A and 2C because they enrolled in your insurance. In February, they're going to be probably, right, they worked for a day, so they're going to be 1H but 2B because, yeah, they worked for us, but it wasn't full-time, and they didn't get insured in that. But, you know, even though they had insurance that first day, it wasn't for the balance of that month. So there are some weird circumstances where you may use 2B. Far more often, though, will be when you're using 2A. Because if you have an employee who's 2B in every month, guess what that means? They probably shouldn't be getting a form because they're not full-time, right? Okay. 2C is the employee is enrolled in coverage each day of that month. This is why you can't use 2C in August for a new teacher. But you can use 2C if your 10-year vet who's always taken full family insurance doesn't change anything for either of those two coverage years. Your most common form on the 1095C forms is probably going to be your teachers, 1A, blank and 15, 2C if they took your insurance in line 16. That's probably the most common form that schools and ESUs will fill out. 2C is they enrolled in coverage. 2C applies, right, before any other code. So if they take COBRA, it's 2C, or it's not 2C because they're not enrolled in your coverage, right? That's 2A because they don't work for you anymore. 2C is the one that you'll use if you ask each employee to pay $150 a month. Check for understanding. Can you use the 1A offer code if you ask them to pay $150 a month? No, because it's more than $102.63. So you'll have 1E, $150 a month. But if they enroll, if they say, I'll pay $150 a month for single insurance, right? That's still 2C. So we use 2C ahead of any safe harbor code, ahead of anything else. This is the only time the government wants the truth from you. Did they enroll? If they enrolled, you always use 2C, even if it would have cost them money, even if it's not a 1A offer, right? If they enrolled, put 2C in line 16. 2D is what we're going to use, what's called a limited non-assessment period. 2D for EHA purposes, since they can always start on insurance the month after they begin, right? At least unless you have them start earlier, which could happen. But you're still probably going to use 2D if for any new teacher. You're going to use 2D for any new para that you hire October 27th that starts insurance November 1st, right? Because that month they worked for you, but we're going to use 2D even ahead of 2B, because 2D is where we signal to the government, yeah, this is just our wait period. They call that a limited non-assessment period. A better term for it is a wait period. Same thing for mid-year hires, new hires where we're not sure if they're going to be full-time or not. This would be used in August for that new teacher, right? We don't know if was that teacher full-time in August. If they reported on August 10th, probably. They probably worked 130 hours. So we can't use 2B. We're going to use 2D because that's what signals to the government. They're just in our wait period, right? That's basically what 2D is. 2E is the multi-employer rule. Unless you're McDonald's, this probably isn't going to apply to you. So if you're a school in ESU, this likely won't matter. And then we get the safe harbor codes, right? 2F is the W-2 safe harbor. That's looking at their box 1 W-2. How much did you ask them to pay per month? You can't use the W-2 safe harbor unless it is equal in all months. That's why most schools that I work with, because our premium levels change, right? In the middle of the calendar year, most schools that I work with can't use the W-2 safe harbor because it's not exactly equal in each month. It could be, but what we're comparing is each static month and what that is at the end of the year compared to their W-2. So that's just a little less predictable, but some schools still do use it. 2G is this federal poverty line safe harbor, which again, the 1A offer code and the 2G safe harbor are pretty much the same thing, right? 9.86% of the single federal poverty line. So this safe harbor you're probably never going to use, because if you could use it, then you should be using the 1A offer code. 2H is this rate of pay safe harbor. That's the one where we take their rate times 130 times 9.86%. We figure out, did they pay less than that each month of the year? If so, then we can use this 2H rate of pay safe harbor. Check for understanding. We have an offer that requires somebody to pay $150 a month. Do we use 1A or 1E? 1E, $150 a month. They enroll in our insurance. Are we using 2H because they meet the rate of pay safe harbor, or are we using 2C? Always using 2C, because the government always wants to know if they actually enroll, right? So that's just, again, where you might have to look back through these to get yourself familiar with it. But that 2C, yes, they did enroll. We're going to use as often as we possibly can. 2I, that used to be transition relief, right? Oh, hearkening back to the good old days. If no code applies, leave it blank. We offer the teacher full family insurance. He or she doesn't take it, no sweat. It's 1A blank blank. Not a problem, right? That is totally okay. That is expected to happen. Don't freak out if line 16 is blank. Make sure you've ruled out the codes you could use, for example, if you need a safe harbor, because we ask them to pay an amount that we have to put in line 15. But it is entirely possible, and in most cases, I think for you, lines 15 and 16 will be blank if you have an employee that does not enroll. You do not have to do part 3. That's always been the case, but if you're new to this, you're not filling out part 3. That's part of what Blue Cross Blue Shield is submitting as part of their plan, as part of what they said. Okay, we're going to take a break. It's 11:03 by my count. Let's do 5 minutes so we can get through this stuff quickly and get to your questions in the forms. So we'll come back at 11, well, let's say 11:10. Send questions via the chat and send me a text message. I'm going to mute us again here, and then we'll be back in a few minutes. Okay, we are back. I do have one question via text, but if you have, again, you've done a great job sending them in. This is the only one I've gotten via text, but here it is. Long-term sub, will this be 1H and blank? Chances are yes, it probably will be, but we'll talk about some more of that as we get through here. Teacher was full-time last school year, but is only an outside coach this year. After September 1st, would it be 1H and blank? Chances are it would probably be 1H and 2B, that they're not full-time, right? It wouldn't be blank, I don't think, because if they are working for you and they're not full-time, I think it'd probably turn from like 1A, 2C to, okay, they retired as a teacher, but now they're a coach. It's probably 1H because we're not offering them insurance anymore, but it's likely 2B because they're not full-time. Husband, wife are both full-time employees. Wife was hired later, was already on full family coverage paid by the school through the husband, so she didn't enroll separately. Should I still mark her as 1A, 2C? Great question. No. Husband and wife are both teachers for the school. Both spouses get a full family offer through collective bargaining. One of them can enroll, right? Unless you're one of these schools that allows them both to enroll in a single plan, which still happens on occasion, especially if you have cash in lieu. But there are places that still allow both of them to enroll on a single plan for reasons I don't understand. What most negotiated agreements say is if you are married to somebody else who gets the same insurance offer as you, only one of you can enroll. The person who actually enrolls is 1A and 2C. The person who does not enroll is 1A blank blank. Right? They got the same offer, but only one of them on an individual basis enrolled. Good question. Keep them coming if you have them.